Hello, I'm Richard Calhoun, real estate broker with Creekside Realty, 40 years. My contact information is down here at the bottom of the screen. The green highlight is what I call the root URL. That gets you basically to my YouTube channel archives of all these presentations. If you add the 2021, the year code at the end of that, you get to this live presentation Saturday morning at 9 a.m. If you add the word handout, the 8-digit year, month, date code to the end of that, you get to the handout. It is posted 24 slides. I tend to get it up about 5-10 minutes before the meeting. So if someone wanted to get it and print it out real quickly, they should be able to do that. For this specific event, you just added the root URL and the year, month, date code without the word handout in it. So with that, we'll get into the purpose of being here, which is talking about what's happening in the real estate market. And we focus on basically Santa Clara County, San Mateo County, single family homes, condos, and townhouses. And we sort of look at the past 5 weeks and the past week. This first graph is looking at two things: supply and demand. In a free economy, that's what drives the marketplace. So if we were having a normal marketplace, the supply and demand would be right on the yellow line. The yellow line represents the 5-year median, which is 2015 through 2019, which were 5 great years. So if you were on the yellow line, you would in theory be having a great year. So let's look at what's happening. Inventory is now below the 5-year median. What happened earlier this year? We had surplus inventory. We had 40% more, and then we dropped down pretty rapidly somewhere by week number 9. We were basically at normal inventory, and we were at normal inventory from week like number 9 through 16. Starting in week 17, we started to have a shortage of inventory, and then it's been basically at that shortage ever since, and it's somewhere around 85% of the level of inventory that we would expect to have out there. Then the flip side of that is demand. Demand is the rust color line. The rust color line shows that you have above normal amount of demand. At the beginning part of the year, it was way up. It came down and it was somewhere around 120%, 115% of normal. We had a shoot up, but this is mostly a perturbation based on the calendar in July the 4th, and a lot of nuances there. And it's been fairly constant, somewhere just shy of 120% of normal. So if you're having 15-20% more demand than normal and you're having 15% less supply than normal, that's what gives us the craziness in the current marketplace. The gray line that I haven't talked about yet is just the number of new listings each week, and basically it's right at the normal level of what you would expect for the number of new listings coming on the market. So the water coming into the reservoir is the right amount, the reservoir is a little bit low, and the demand for the water in that reservoir is high, making that resource a scarce and hard to find and competitive. And that's exactly what we have going on. Now we're looking at days of unsold inventory. That's the ratio between that supply and demand. And again, the yellow line is the 5-year median. And so you can see that it comes plunging down at the beginning part of the year. It stays flat for a while, and then normally it increases. This year, it stayed flat for a whole lot longer. In fact, I would actually say, it's hard to say right here with the July 4th perturbation what happened, but I would say it wasn't until here that we really had any increase. So basically, that's week 28, then 29, and 30. So only the last 3 weeks have we had an increase in DUI, which is a slowing down in the marketplace. You also need to put it in perspective, because we're talking about numbers somewhere between about 22 and 29 days of unsold inventory. And I consider 40 to 80 to be a balanced marketplace. So even though there's a slowing down of the marketplace, it's still very much a seller's marketplace. And that's exactly what I believe is happening on there. We have a strong marketplace. It's not as crazy as it was 3 and 4 and 5 weeks ago, but it's still pretty crazy. Now what we're looking at is the overbidding, and this requires sale price. So not only are we going back in time for 1 week, because each line here represents 1 week of data, but you're going back about 5 weeks before that week to allow for the time for the escrow to close, because these are closings that occurred since Friday night through Saturday. And obviously there's no recordings on Saturday, but believe it or not, there are reports of closings on Saturday and Sunday every week. We know they didn't happen. They happened either Monday or Friday. I graph them statistically based on when they're reported, because there's no way for me to know when they actually recorded without doing a whole bunch of work. So the purple line here is the most current week. And what's interesting is on the higher end here, basically from about 50% up, it's been falling down a little bit. So buyers aren't overbidding as much. They're not feeling as much pressure as they were feeling for the last 7, 8, 9, 10, 12 weeks. And if you look about it, it's actually fairly significant. This yellow orange line was last week, so it came down quite a bit, and this week is actually up a little bit, but those are both down fairly significantly from the cluster higher up than them. It's still a strong marketplace. So, you got to be careful of what I'm conveying, because if you look at this, you come down here and it says more than 75% are getting over their asking price. More than 85% are getting their asking price or more. That, in other words, about 10% are getting more or less exactly what they're asking for their property, and only 15% are getting below, and 75% are getting above. That is a strong marketplace. And when you're starting to talk about 5% of the people are getting almost 25% more than they're asking for, that's pretty crazy. But the dotted line out here is the best month we've ever had, and the worst month we've ever had is way down here. So you can see that we're towards the top of the range where we'd expect to be, but we are down from where we were a couple weeks ago. This table is probably the most surprising. And what really jumped out at me was the median sale price appreciation for Santa Clara County. It's now only at 17.5%, a drop of 3% from just last week. So and this is 5-week data. So if you start thinking about this for a second, I took the data on the 23rd, I went back 5 weeks, and now I took the data on the 30th and went back 5 weeks. 80% of the data is the same data. 20% is new. So in that 20% new data, it was able to bring down the appreciation by 3%. That's pretty significant. Then what I looked at before I started the meeting was, where was it coming from? Because if you look at South County, it's flat. If you look at East San Jose, it's flat. But then if you start looking at Blossom Valley, Santa Teresa, it's down 1%. The moderate areas are down 2%, and that's like Campbell, Cambrian, Willow Glen. If you look at Cupertino, Sunnyvale, it's down 1%. And then Saratoga, Los Gatos is down about 3.5%, and Los Altos, Palo Alto is down about 2%. So if you look at each individual area, they're down less than the county overall. So that's telling you there's also a shift in the market mix. And this is a great example of one of the reasons why I started doing micro markets, is because even when you look at a county basis, if all of a sudden if all of a sudden lower priced areas had more activity, that's going to bring down the county-wide number, even if those values have gone up in value. So this could be mostly a shift in market mix. And I would actually say it's got to be to some degree a market mix shift, because some areas had no change whatsoever, and none of the areas had a change greater than the county-wide data. So it's at one level, when you first start thinking about that, you might say, wow, that means your data has to be wrong, because how can the average of everything be greater than the sum of the components? Well, if all of a sudden, when you're looking at a large increase, say, in the volume of transactions at the low end, that will bring down your median for the county without bringing down the median in any one area. But still, to see the price drop for the county was a little surprising for me. And there's also a bit of a price drop down in San Mateo County. And with that, I'll pause and see if anyone has any questions before I get into a little bit more details. So does anyone have any questions for me?
Okay, this page, you're talking about a 17.5%. Is this a annual percentage?
It is not a true annual percentage. One of the problems that you have, and that's a very good point, is what do you use as your base? And if I took a year over year as my base, that would be an annual percentage. But the problem with that is you have fluctuation in your base, and you have fluctuation in your current data point. So they're both fluctuating, and you don't know which one's doing. So I made the decision that for my base, I'm using the entire calendar year of 2020. So I took the median price for the entire calendar year of 2020 and comparing it to the price for the last 5 weeks. So, and then the reason I have the median close of escrow here is it gives you some idea of when that median price was probably achieved, because that was the 50 percentile point on the escrows. And so basically that was around the first week of August, and we're pretty close to the first week of August. So in this particular week and next week and the week after that, yeah, it's roughly an annual percentage rate, but it's probably closer to the appreciation from somewhere around the first week of August of last year to now. But that's not what it truly is simply the appreciation over last year's calendar median price for the entire year.
Okay, yeah, so it is now I know the 17.5 is the annual percentage from last year, August to this year, August.
It's well, you don't know. There is no way to know when that median price really occurred. It's the median price for the entire calendar year. The 50 percentile mark happened in August, but because all the median is you take the long list of every transaction in the calendar year of 2020 and say, where is the price in the middle? And you don't know, you have a price in the middle, but it's going to have several transactions and you really don't know when that price happened. So it's normally when people talk about an annual price, they will talk about something like the month of July and compare the month of July of last year to the month of July this year. Well, I don't have the complete calendar year to compare it to. In fact, a more accurate comparison to get annual appreciation would be as if I took from January 1st to now and found out what that median was and compared it to last year. But that's not apples and apples. The only way to get an annual appreciation that's stable is wait until the entire calendar year. And I didn't want to wait that long. I could do something like a quarter where I take 91 days and look at what the annual price was last year, 91 days ago to this year, because that would be pretty stable. But the goal is not to show the real percent. The goal was sort of to show the increases and then now apparently the decrease. So it's not real. The magnitude statistics are meant to give you some understanding of what's happening in a marketplace or in a sphere that is too large for you to understand without assistance. So this is just a tool versus an exact answer.
Okay. Well, at least I know this is the 12 months, the average, the percentage.
I'm comparing it to here. I'm comparing it to the median sale price for 2020, right here where my cursor is.
Right.
So it's the 2020 sale price median for the entire calendar year, and then comparing that to the median price for the last 5 weeks. So
okay, got it.
It's not an annual appreciation.
No, I understand that. But the 17.5% is not for the 6 months, it's for 12 months.
It's closer to 12 months than 6 months.
Okay.
The reason I'm hesitant is back here on May, it was not a year appreciation. It was basically appreciation from, the first week in August of last year to May 22nd. So I keep going back. I understand the desire to want to put a date of when it happened. And that's sort of what this column here is about. And you can see there's some difference of when it happened, but that's not when the median price per se happened, because you don't know when that median price happened. It's where the median escrows happen. So it gives you some idea where the 50 percentile point was. Now, granted, the earlier transactions would have probably been at a lower price and the later ones were probably at a higher price. But you also have to remember in 2020, we were impacted by the pandemic, and those that closed in the month of April and very early in May were artificially low because of people were freaked out. But once we got back going, prices skyrocketed. And I don't think anybody was expecting that.
Okay. I think I understand it.
Okay. This is my normal data. This is the data I've been using historically. So when I say Santa Clara County single family homes, it's pretty much Santa Clara County single family homes. When I come down to look at San Mateo County single family homes, there's little pockets like La Honda, and I'm not thinking of any others, but there's a few pockets that I don't count and I don't do countywide data. So this is Richards, San Mateo County, which is probably 99% of San Mateo County. In San Mateo County, I don't get all the data for the San Mateo County condos and townhouses. I ignore the Half Moon Bay area because there are condos and townhouses there, but there's not enough to make a micro market area. So I only look at two areas. I look at what I call the Bay Cities, which is everything, from the summit down to the bay, south of basically Daly City. And then I look at Daly City, San Bruno, and Pacifica as a north area, but I don't combine it. So I'm labeling this, instead of San Mateo County, I'm labeling this as Bay cities. And that's why it's at 22 days, because we're about to see a slide where I think it's going to jump to about 30. And that's where I'm taking into consideration the whole county. So I'm a little confusing on you guys, and I'm sorry about that, but my days of unsold inventory isn't consistent, and I may drop one of them, but you just have to, if it doesn't make sense, you have to go, oh, which days of unsold inventory is he using? So with that being said, that doesn't apply to frequency of overbidding and magnitude as much, because they don't change as dramatically in the different areas, but the same argument does apply. But anyway, purpose of this slide is to show you which areas are hotter than colder than others. So with the frequency of overbidding in Santa Clara County at 83%, it's the hottest. The magnitude of overbidding at 109% is slightly lower than it is for San Mateo County single family homes. So even though they're not overbidding as much as frequently in San Mateo County, they're overbidding more, and they have a higher days on sold inventory. And the prices of homes are up, more expensive. Maybe people are a little bit looser with their purse strings, which is why this magnitude can be higher. Again, also, a percent difference isn't that big of a deal when we're talking about, people just shooting in the dark. What's it going to take for me to get this particular house? One person pays 1% more than the next person, and all of a sudden you get a percent higher over here. Anyway, so you can quickly see that all the areas are doing well. We're basically between 75 and 85% of the sellers are getting more than their asking price. They're getting either condos and townhouses are basically getting 105% of their asking price. Single family homes are essentially getting 110%. Their days on sold inventory are all pretty aggressive, but they're getting a lot closer together. Earlier this year, these were up in the high 30s and these were down in the mid-teens. Now they're all basically right around 25. So the speed of the marketplace has leveled out quite a bit, which is interesting. So now, just since we were talking about it, we'll jump right down to it. So you can see condos and townhouses down here are at 30, and you can see Santa Clara County's at 29 and San Mateo County's at 35. So just go back, you're at 26 and 22. So the 26 is a little closer to the 29. The 35 here is nowhere close to the 22 here. And again, the reason for that is this 22 is only Bay cities. This 35 adds in the entire county, because what I do is I just get on the computer and say, give me everything in the county. So I do these as a gut check. So if someone wanted the county, these numbers for days on unsold inventory are more accurate than these numbers, but these numbers I think are more relevant of what's happening in the marketplace, because you take care of some of the shifts to some degree. You don't include some of those really weird, strange outliers that can impact the data place. In other words, if most of your data is somewhere around 25 days and an outlying area is at 50 days and it's a small area, do you include that 50 days or do you exclude it? So on this table, I'm including it, so the data is slower. On this table where I was trying to do it for market, because this is what I've done long term, I exclude it because I'm trying to get a better feel for what's happening in the marketplace. So I hope that's not too confusing, but that's why there's a discrepancy in the data. And the reason I'm bringing it up more than anything is that it confused me last week. And last week I had lines through them because I wasn't believing them. So now I went back and researched and figured out what was going on. So anyway, again, what we're trying to do is we're looking at the active listings last week on how many there were compared to this week. So inventory has gone up almost 100 homes in 1 week period of time. And if you start looking at it, San Mateo County went up fairly significantly. Santa Clara County actually went down. Again, the same thing over here. San Mateo County went up in condos and townhouses, and Santa Clara County went down. So that now you have two different counties that are going in opposite direction. So when you look at this 100 or 75, 80 home increase, where did the increase happen? Well, there was actually a decrease in Santa Clara County. So the increase was more dramatic in San Mateo County and was hidden to some degree by the improvement or the decrease in Santa Clara County. So that's one of the reasons why I look at so much data, is if you just look at it globally, you can get the wrong conclusions. Offers in the last week and 5 weeks. So here is just a snapshot of what's happening real quick. You can see we sold about 535 in the last week. In the last 5 weeks, we sold 2562. 2, and then you can see the different breakdown. And the real goal is to get down to days of unsold inventory. And you can start seeing that the 5-week, this is sort of what drives the marketplace. Santa Clara County is the biggest area. 5-week is more stable. So we're at 23.8. But if we go back just a couple weeks, we were at numbers like 16 and 17. So the market has slowed down fairly significantly, but it's still a very strong marketplace, and I'm not worried about it going slow on us or anything. But with the slowdown, you may see, less number of buyers, less aggressive bidding, and that kind of thing on your offers. This is it graphically. It's just showing the 3 major components, being the red line being Santa Clara County single family homes. It's the hottest, followed by Santa Clara County condos and townhouses in yellow, and then the gray being San Mateo County single family homes. And I corrected a couple of my bad data points, so it's smoothed out quite a bit going forward. Here's my heat map. The redder the color, the hotter the marketplace is. So you can see basically the entire area is in a hot marketplace. Everything is red in color. Saturated red is basically at 10. So the only saturated red I think is going to be Foster City, and it's barely saturated at 9.8, but it's a pretty small little tiny pocket right up here. And I would actually say I can't perceive the difference between that and San Mateo County. And in San Mateo County, it is Bay City's 18. So even though there's almost a doubling of the days of unsold inventory, the coloring, I really can't pick up the difference. But again, the concept is simply the redder the color, the hotter the marketplace, the lighter the color, the slower the marketplace is. But a white color is what I call a balanced marketplace, and the only one that's into the white at all is Menlo Park, Atherton at 69 days. Now what you're looking at here is the active listings without inventory. So this is what's currently available. You can see at the beginning part of the year, we had more available inventory. Then for a long time, we had the same that you would expect. And it's noteworthy because even back here, when we had more inventory, and definitely through here, everybody was complaining there was a lack of inventory. And I had to maintain it's not a lack of inventory. It's exactly the amount of inventory we should have been having. It was a surplus in demand. Now we finally, and basically for the last 15 weeks, we have had a lack of inventory. And you can see that, we're still growing. We typically grow until about the middle of July. And you can see that's actually a little bit of a misnomer because, this is a 5-year median here, and that's week number 39. So that's going to be like after Labor Day. So it's single family homes in Santa Clara County that sort of peak somewhere around July 19th, typically. When you put in condos and townhouses, they tend to be a little bit more stable. You put out the peak marketplace later than the year, and that's an interesting observation. Here is the number of new listings for the given week, and you can see that it's tracking exactly. Yes, there's some perturbations, but it's exactly what you'd expect, the number of new listings every week. So it's a combination of the lack of inventory because it's been a hot marketplace for a long time and the surplus of demand that's driving the marketplace. This is the number of new offers accepted. I think we're going to stay above, but we're going to get closer to the yellow line. And the reason I'm saying that is with less inventory to pick from, it's harder for a consumer to find a property they want to make an offer on. And so that slows down the volume. This is the number of new closings. That's going to be the same as the new offers, just delayed by about 5 weeks. This is the frequency of overbidding. So you can see we're still up here in the stratosphere. Basically, I consider anything above 50% to be a strong seller's marketplace. And you can see we're up here somewhere around 83%. When 83% of the people are getting more than their asking price, that's pretty amazing. And that's closings based on the last week. So, this is as of about 5 weeks ago as far as the actual marketplace. This is the frequency for each of the different major components. The red line being Santa Clara County single family, San Mateo County single family, and then condos and townhouses coming in third place. But again, even third place, it's somewhere around 75% of the sellers getting more than their asking price. That's a great consolation prize. Most people would be very happy with that. This is the overbidding heat map. The redder the color, the hotter the marketplace, the more overbidding. I will point out again that I don't understand this, and I'm going to have to dive deeper. And I did look a little bit today. It does appear to be working in my raw data, but we're coming in at 96.3% again for Cupertino Sunnyvale. So there should be fluctuation every week, and the other areas are fluctuating, but when it doesn't fluctuate, And I think this is the third or fourth week now that it's been there. So I'm going to try to go back and find out what's going on. I did have a problem earlier that I corrected, but it almost seems like it's back, but I can't find it. So I have no knowledge that the data's wrong, but for it to be at the exact same percent to the 10th of the decimal place raises any person's suspicion. So my suspicion's up, but I'm not sure the data's wrong. And it appears to be only that area. So that's part of the other reason why I'm having a hard time questioning my data. This is the magnitude of overbidding. This is how much. And it does surprise me that you have this kind of fluctuation going on, but the magnitude has always been a very raggedy, jittery statistic, because when you go from, 110% down to 108%, you go, wow, what's going on? But then the next week you're back up. And that's one of the underlying goals that I have in my data. I'm trying to find data that is representative, leading indicators that is constant enough that you can get a magnitude. So I think people need to be aware when they look at something like this, you can't just go, wow, it's 110% down from 110.5% and say that makes a difference. What the real story here is you're somewhere around 110% versus somewhere around 100% or somewhere around 98%. That's what the real story is, not what the exact magnitude of the number is. Here is just the heat map showing the areas that have the most magnitude of overbidding, where the people are willing to pay the most over. And basically it's Foster City, followed by San Mateo County north, followed by the Bay Cities. And then you finally get into most of Santa Clara County coming in. And I probably overskipped Cupertino at 115%. This graph we looked at earlier, I bring it back up to talk about this graph. And this is just to show you now, out of the last 12 weeks, the orange week, which is last week, and the purple week this week are the worst two. So 2 weeks in a row, we've had the last 2 weeks of overbidding, but it's been mostly at the top end. So this is just saying that, buyers aren't willing to overbid quite as much as they used to, because down in here, right through here, the purple's actually almost on top. And so, in the yellow, which is July the 10th, is the top. And that's the top pretty much all the way around. So basically what I'm saying is escrows that closed the week of July the 3rd through Friday, July the 9th, reported on July the 10th, was the week that had the most overbidding. And since then, we've been cooling down, with the last 2 weeks being the slowest. So basically, there's only one other week, and it's the gray line, which is hard to pick up in here, but it's a solid gray line right through here. So you had the peak week, down a little bit, down a lot, up a little bit. So it's clearly no longer this progressively moving up and up and up and up. We're at a plateau where we're having a little bit of a bounce, and we're bouncing at a lower level than we were at the peak. Here is your price. The white color in this case is the median, and I assign the color coding based on the median because each micro market area has 3 numbers. The low number is the cheapest 10%, the middle number is the median, and the top number, the right number, is the highest in that area. So 80% of the homes are between $1.1 and $1.7 million in the Milpitas, North Valley, Berryessa, and Santa Teresa area. And what it basically says is blue colors are below the median, red colors are above the median, and you'll notice there's quite a bit of areas that are basically very pale. They're essentially at the median. And when you look at it, there is some fluctuation, and it shows up more over here. Cupertino, Sunnyvale's at 2.3%, 2.13, and 2.33. So, the Bay Cities and Cupertino, and actually maybe there isn't that much. Foster City, Bay Cities, and Cupertino are essentially identical, and Redwood City is essentially right in there, 200, it's within 10%. And when you look at these, they're all roughly the same color. So there's a large segment of the area that's the median for both counties combined. The blue areas are where you go if you want to buy homes below the median, or if you have a set dollar price, as most consumers do, you tend to get more house for your money in the bluer area. This is looking at the data now for the month of June, and this data is from the first of the month following. So this is back on July the 10th. So it's really not comparing apples to apples of where we are now, but this sort of gives you an idea where we are now compared to last year. And I thought this was the slide that would come up first, but the order got reversed on me, or maybe I was just mistaken. This is where I'm now comparing. Okay, so this is not going to be as pretty because it's in Excel, but now at least I know that I got current data. So what we're doing now is we're comparing July 31st 21st, data from today, which ended yesterday at midnight, to data that normally I get on August the 5th, that would be through August the 4th. But the purpose here is to be able to give an idea, because, it doesn't take a rocket scientist to realize if I'm going back 35 days, I'm going, because this is going back 35 days. I'm not starting on July the 1st. So I'm including some June data, but I got almost the entire month of July on there. So yeah, I have 5 days or 6 days from June, and I'm missing 1 day from July and 4 days from August. So, it's not a direct apples and apples comparison, but it's pretty close. And what you're able to do now is you're able to come over and see the average days on market is 37. And if you go back, you can see that at this time of the year, that's basically a record low. 14 days for median days on the market, that's basically a record low, except for, you were close back here in 2012 and just going all the way back. Yeah. So that's basically strongly indicating that your market's, aggressive and moving quickly. What's sort of interesting is your median ask price for what's on the market is at $1.6 million. So people are actually asking for less money now than they did last year, even though the sold prices are up 20%. And at first, that should be a head scratcher for most people, but it can be as simple as there's more activity in the low end of the marketplace. If there's more activity in the low end of the marketplace, that brings down the median. And if what's selling is your normal mix, that would come back up on your sale price. So that's why you have to compare apples and apples so carefully in statistics, and why you can make statistics say anything you want them to say. Inventory is 825. You can see in 2017, which is what I'm saying we're very similar to, was 834. So it's almost a direct match. But you go back all the way back to 1999, and there's no other year that you're even in 3 digits other than last year. So basically, in 17, of course. So basically, the low is somewhere around 1,200 listings. We're only at 2/3 of that, and that's the kind of thing. And the reason this number is so much dramatically lower than when I'm saying we don't have any inventory, we have inventory. In my earlier slides, I was saying we have 85% of the inventory. That's in both counties and both types of product. This is Santa Clara County single-family homes, which is the hottest marketplace. So this is where you do have a shortage, and you basically are somewhere just guessing about 65% of the single family homes compared to 85% of everything combined. And again, this down here, let me move it over. You can have the square footage being 1,920 square feet, the bedrooms and bathrooms, getting down to average days on the market. This is a little bit more consistent and a better number, because this is what the buyers are willing to buy. So now you look at 15.2 days and 9 days. And if you look back, you can't find anything close to that. And again, the closest thing is 2017 right here, where you're at 19 and a half and 11 days. So we're moving more rapidly than we did in 2017. Our days of unsold inventory is 24 versus 25. So from that point of view, remember I was saying that the market's slowing down. Yes, the market is slowing down, but it's the hottest market we've ever had at this time of the year. So that's the kind of perception you have to be careful of walking away with a wrong perception. I'm trying to convey what the market's really doing as accurately as possible. And just at the beginning, I talked about the median list price being lower than it was last year. Look at the median list price of what's sold. It's 1.5 million versus 1.4 million. So it's $100,000 higher, where what's on the market is $100,000 lower. And it takes a while to start getting comfortable with this, almost what appears to be a conflict and not possible, but it very much is, because they're different sets of data. You can see the square footage of the homes are very similar, and also I'll point out very similar to what they were back in 2017. Now, if we get down to overbidding, we're looking at the magnitude of overbidding at 110%. If you look back, even 17, it was only 105%. So we're 5% above the previous record for this time of the year. And magnitude of frequency of overbidding at 85%, we're 10% higher than this time of the year. So even though we're down from the peak, we're basically at a record time for this year. So that's why understanding the cycles of real estate and looking at the cycles are so important. And then if you look at the median sale price, here's your year over year comparison, Lily. You're up 105% versus 850,000. Yeah, 850,000. So that's more than 15%. That's 20%. It's close to 20% up. Your median price is 1.4 to 1.6. So that's up about 15%. And your high end is up from 3 million to 3.4. So that's just a little bit over 10%, maybe around 13%. Those are just rough numbers off the top of my head. I could be a little bit off. And you can see the median list price went up from 1.3 to 1.5, and the closings were 1279. So with that, I'll pause for questions, and I'm going to go back to my PowerPoint and see if I did have the right data on my PowerPoint all along or if I didn't. But now you should be in PowerPoint for the current slide. So
right now it's the PowerPoint.
Thank you. So this data was correct. So I just didn't change the date. So I went on a red herring, but I'll bring this up because it's a little bit nicer. But you can also see it a little bit clearer on here. So sorry about that detour. Any questions? Because that is my last slide for the day, other than my URLs. So I'll leave that up for people to look at it a little bit.
Yes. Yeah, I think if we're looking at it, the sale price, the 10% and median 90%, and then yeah, it is about like 15% or 15% increase.
Year over year, yes.
Right.
And that is lower than the 19% or whatever it was that was on the other table. So this is your annual percent increase that you were asking for about earlier.
Right. That's about,
And that what's hard to understand is the number of decisions that go into not calculating, but determining what benchmarks are reasonable. And what I try to do is give benchmarks that are reliable and useful in determining what the market is doing. And that it's more challenging than it sounds like it is. And it's because of nuances like that. Is this the annual percent appreciation or is the other one? This one's going to fluctuate quite a bit because not only does the number here, the 1040 and the 1650 and the 3.4 change, but the 8.5 and the 13.8 and the 3.0 change too. So you have two things that change every time you're reporting that annual percentage appreciation. And that is why I made the decision to use an annual median, because now it's anchored. And the only thing I'm doing is I'm looking at the difference of what's happening in the marketplace this year. So this is where you go to see what's happened since last year. The graph that I was showing is what's happening from this week to last week. So this week, the amount of appreciation is down from last week. And if I was doing annual comparisons, I might have been getting a different answer. And we're just about out of time.